And all right, so hopefully this is going to be legible. All right, with that. So if you go to the home page, there's a link on the lower right side, financing green growth with capital ownership opportunities for every citizen. The first slide is just so you see all the major elements within this monetary system that we're proposing and the interrelationships. And so what I'm going to do is go through each of these various steps one by one, and I'll open it up to questions one by one. Okay, so as Norm was saying, there's a process by which we determine how much capital credit is going to be made available each year. And so each year, annually, biannually, or quarterly, the government will estimate how much productive capital will be added to the economy in the coming period, both in the private and public sectors. And this could be the government, it might be the central bank or some other body that makes that estimate based on what businesses say they're going to need. So dividing that number of projected total capital formation financing needed by the number of US citizens and all eligible participants, that would give us a number which is for each citizen, how much capital credit, interest-free capital credit, are they entitled to receive if they can find, match it up with the sale of shares that are qualified. And so we give an example here of the about 4 trillion and then the 2018 population. So both of those numbers are larger. So what resulted was about $12,000. And we decided to simplify this so that if you go to there's another link on the home page, which shows the projected accumulations throughout a person's lifetime. And that's keeping very conservative projections, not taking into account that the economy will probably grow as you have more customers with money. So, but this was just to give people an idea of how much through this capital ownership account they could accumulate over their lifetime. So here, the first step, as we said, was the periodic calculation of capital credit, whether this is the government or the central bank or another official body. And so it will determine how much each of us through our capital ownership account are entitled to receive in terms of newly created interest-free capital credit. So the next step is that, and the timing of these steps, we have to, maybe clarify that everything is determined by the need of the enterprise wanting to grow. So for purposes of this diagram, the enterprise that needs to finance its new capital assets will decide that it's going to do so by selling newly issued shares to the citizens at the current market price. There's a benefit to doing this in that the enterprise will escape paying corporate income taxes on all the full dividend payout voting shares that it sells. So any future dividends that are not used to repay the capital ownership loan would be paid out as personal income and taxable at the personal individual level. So if we take a family of 4, they would go to their local bank to set up 4 individual tax sheltered capital ownership accounts. And so knowing that the children are not going to be qualified to make investment decisions, the parents would be making those decisions on the behalf of their children, and the parents could have professional assistance in determining what the best investment for their particular circumstances are. So they get advice. This could even be from the bank where you set up your accounts. And the account will be what receives the annual capital credit allotments. Okay, so here we see the second step is that here you have the corporation wants to do a green growth project, and the way it's going to get its money to acquire all these the assets it needs, it's going to sell shares to the capital ownership account, which is set up probably in one of the commercial banks. Step 3 is the enterprise, as it, when it takes the money, it's going to get money, and that new money is essentially, it's the counterpart of the capital credit. So it's capital credit to the borrower, this citizen, through their ownership account. But the enterprise needs some kind of the money in the form that can go out and buy whatever plant and equipment or whatever it needs. So as it generates profits from using that new capital, it pays out each year a certain amount that goes to the capital ownership account, and that is going to be channeled back to the lender. Okay, so saying here, it guarantees, it promises to pay out all of its profits. These have to be full dividend payout per share, and that's going to be going, it's guaranteed, this is the guarantee that is made to the lender, the bank. Okay, then the family is going to present bills of exchange, and Mike is going to explain this in a little bit more detail. This is where it starts to get kind of technical about how these are done, but the bill of exchange it's essentially a promise that the credit will be used to purchase these profit-making shares, and that the profit will be used to, there'll be also corresponding what's called a promissory note that the borrower promises to pay so much back to the bank.
Why don't you
So
give you lift that
oh, sure.
diagram so people can see the full diagram, right?
Okay, sure. So here it's going to present this bill of exchange. It's a promise. Okay, and it's how it connects the capital ownership account to the lender, the commercial bank. So this is an important piece of paper, the bill of exchange. Okay, and that's states what the transaction is going to be with regard to this shares being sold by this company. So once you have this bill of exchange, and this is something that can be drawn up even by the bank itself, so it doesn't require that citizens be lawyers who have to write these documents up. So that's going to be in this transaction here. So going back, okay, so I'm going to just read this. So before the loan is made, the lender, the bank, the risk insurance company, and other entities will first determine the feasibility, and we talked about that, of each loan. And that means the enterprise's new capital will be expected to generate enough profits to pay for itself. If it can't show that it's going to do that, it's not a feasible loan, and it will not be able to sell its shares. And so it's kind of out of the picture. So it has to judge the soundness of the enterprise, the quality of management and workforce, its current and future markets. So that feasibility analysis, that even takes place before you can offer your shares. The bank, in turn, in exchange for this bill of exchange, the bank is going to issue back to the citizen through their account a promissory note for each capital ownership loan. Okay, and it's going to have a special checking account, and I assume this is the in the capital ownership account, or Mike can clarify that. So we call this process discounting, where the bank deducts from the total loan that's made a one-time premium for, it's administering the capital credit and a certain amount of profit for the bank, service fees, etc. So the difference between a service fee and interest charge is interest is charged every year or whatever period of time that you have a principal still owed. The amount you borrowed, it's going to get charged interest, until the end of the life of the loan, over and over and over. So this is just saying we've determined the total cost for getting this loan, and we can divide that total cost over the life of the loan itself, but it's basically one charge. Okay. Then the next step, this is where the bank is guaranteeing to the capital credit insurer that it will add a risk premium to the loan amount to purchase, because now and the premium that's paid and the bank service charge, it's all going to be repaid by the future profits generated by the corporation. Oh, I'm sorry. I just realized what I did. Sorry, Monica. I went. You had such a good idea that I stopped between every step. I kind of blew through that. So yeah. So why don't I pause, because I kind of went past where I was supposed to. So let me take let me see the
Monica should be first.
okay, Monica.
Well, I did, and you know what? I had that hand up from before, but
Sorry.
is the premium charged every time there's an allotment or a loan, or the COA gets an annual allotment? I don't know what else to call it. So is that premium is then taken out? It's not a one-time fee, it's a fee every time it's activated, I guess, right?
It's a fee on each loan. So there's only one total fee on each loan, but you're getting a new loan each year.
Each year, so there's a fee.
Yeah. So I don't know. Yeah. So did that answer your question?
Yeah, I just wanted to.
Okay. Yeah, no, it's a good question. John?
Yes, on the bill of exchange.
Okay.
A simple, I seem to be picking up. First, I was picking up, you keep calling interest free, but in your print, there is no statement of interest free each time you say it. It's interest free because the interest is as part of the bill of exchange. There's a comment in there about interest, how the interest will be paid off before before you have a right to get to your value. The debt and the interest are being paid off through the bill of exchange explanation. Yes or no?
No, I'm trying to see if we said anything about repaying interest, and I don't think we did. It's only a service charge. So yeah,
that's right. There's a service charge to
so let me see.
No, I know interest is not mentioned. That's why I questioned it. So I figure this is the point that it must come in about interest, because your whole notion is the capital account. Go ahead.
Okay, so that's a good point, is that somewhere we have to, let me see if I explain it somewhere else. Let me see, let's pay annually. Okay. Just double checking here whether our language is not clear. Feasibility.
Well, one of the main problems is that the science of finance sometimes uses indefinite or vague terminology and sometimes incorrect terminology, which has become embedded. For example, interest, strictly speaking, applies only to a loan of Strictly speaking, interest applies only to a loan of existing money. And this is why this is the main difference between a mortgage and a bill of exchange. A mortgage is an existing or past savings instrument on which interest is paid.
I understand that. Let me give you one example. I'm going to interrupt you because if I borrow for my insurance policy, interest is not paid at the end of the period. It's paid right up front. And I thought maybe you had a mechanism in mind to be like that.
Well, no, I would have gotten to that because they mix up the term. Sometimes the discount is referred to as imputed interest, and it's referred to that in the literature, but it's wrong. Now, the difference between a mortgage and a bill of exchange is that a mortgage pays interest. A bill of exchange is discounted. In other words, you have the bill of exchange, say it's for $100,000. The bank or the financial institution creates $98,000 if it's discounted at 2%. The borrower pays back the full $100,000. That 2% is the service fee. out of which the bank has to pay all its costs and see any profit, if any. And some experts or financiers refer to that as imputed interest, but strictly speaking, it is a discount, not interest. And it has to come from other funds. So that, and that discount is usually amortized over the life of the loan. It's not paid all at one time. So that, say you have 10 payments of $200 each for that $2,000. Excuse me, you've got $100,000 in 10 payments of $10,000 each. Of that, trying to do the math in my head here, $200 of each $10,000 payment is the discount because it's amortized over the life of the loan. So if you have 10 payments, then $200 of that making up the $2,000 discount. So it's not all paid at one time. So this is why some experts will call that an imputed interest, but it's not. Now, of course, for a standard mortgage, sometimes you will have, they say, pay the interest up front because we want to get it right up front. Or sometimes they'll say, and this is what caused the problem with the Dust Bowl in the 1930s when they had balloon payments of principal. All you paid over the life of the loan was interest, no principal. And then at the end of the term, you refinanced, which meant that you had to come up, if the loan was called, which it was in the 1930s, in many cases, people were screwed because they had to come up with the entire principal amount instead of having paid it over time. And I'm starting to talk too much on this because they can get into very technical, but
maybe on page 4, you might put in more information on the bill of exchange, imputed interest, but it's not interest, and this language, because I got stuck when you had bill of exchange and I put question mark, and you're telling me that there's more information behind the statement, and you keep talking about interest-free amount. So, and then you don't discuss where the interest is. So that clarification needs to be on step 4 or someplace. Thank you.
Okay, thanks. Yeah. So moving on to 5, this is the bank is saying to the insurance company that it will add in whatever risk premium, a one-time risk premium, to the principal amount that's going to have to be repaid. Okay. Step 6, okay, this is where the capital credit insurer insures each of the loans. So we have to have that capital credit insurance standing in place of conventional collateral, which means the assets that the borrower has that the lender can seize if they don't pay the loan off. Okay, so
I can't hear.
Oops. Sorry, am I
You're good.
Okay. Okay, so let's see, lost my train of thought. Okay, so as I was saying, capital credit insurance takes the place of traditional collateral, which is a barrier to most people being able to get loans for capital investment. Then the 7th step, the next step, is that commercial bank will bundle all the loans. Okay, it can either, I mean, if it went directly to the discount window and it has 100,000 loans, that's going to be rather cumbersome. So one of the practical steps is you may have a syndicator that helps to bundle all the loans that this entity is making in order now to go to the discount window of the regional Federal Reserve Bank. So the Federal Reserve, we're really talking about 12 regional Federal Reserve banks in specific areas of the country. Okay, step 8 is then, here we go, the bank is, and this is after it's bundled, it's going to the discount window of the regional Fed for rediscounting. Okay, so there's going to be another amount that's taken out of the total loan created so that the Fed can pay for its, labor, whatever its wages, salaries, whatever expenses it has for creating money. The next step, before I go, let me go on. Does anyone have any questions? I obviously need some practice in just taking questions.
I have a question.
Okay.
So when the rediscount happens, just like Mike explained, the 98%, that 2% is going on with the COA account and the bank. The rediscount at this part of the equation, how is who's
Okay, let's I'm gonna let Mike explain. The discounting takes place here, the rediscount takes place here. So Mike, do you want to give a fairly simple explanation?
The very first acceptance of a bill of exchange is called discounting. All subsequent acceptances of that same bill of exchange are called rediscounting. Now, we assume that the very first discounting or acceptance of a bill of exchange will be at the level of the commercial bank when the prospective borrower presents, his project, and it's either his or her, and it's either approved or disapproved. If it's approved, then they sign all the paperwork, and the moment the borrower signs on the dotted line on the promissory note, the bill of exchange is accepted and discounted right there. Now,
right?
If we have the 100% reserve requirement put in, and all qualified paper is immediately rediscounted at the central bank, the commercial bank turns around immediately and presents the bill of exchange, probably bundled with a whole bunch of others, to the discount window of the central bank. That's rediscounting, because what the central bank does is issue its own promissory note obliging the commercial bank on those bills of exchange. And it uses that promissory note signed by the commercial bank to create a demand deposit in the name of the commercial bank at the central bank. That demand deposit backs the new demand deposit for the borrower at the commercial bank level. So, and frankly, this chain, as what Henry Thornton pointed out over 200 years ago, can be endless as long as nobody breaks the chain and it goes straight. So that you can rediscount forever, as long as when that bill is redeemed at the level of the original borrower, that money that the borrower repays goes the whole way back to where the bill of exchange stopped, and then the redemption follows through. So that ultimately what the original borrower does is buy back his original bill of exchange after it goes through all those steps. In our system, we're saying there would probably be only 2 steps, from the commercial bank to the central bank. And then when the bill is redeemed, from the central bank back to the commercial bank, back to the original borrower. Now
so that 2% stays 2%.
No.
Okay.
The original discount can be 2%. When the commercial bank turns around and rediscounts it, that may only be 1% to the central bank. Because otherwise the commercial bank won't make any money.
I see. Okay.
And the central bank won't be able to cover its costs. See, each time something is rediscounted, the discount is smaller, because you're getting closer to the maturity date, plus the fact that each person along the way wants his profit. Otherwise, why would he bother to do it?
Okay. Okay. That makes sense. Okay.
Well, it's a little not.
No. That
Yeah. We'll
sense.
move on. Yeah, I'm not. The way Mike expresses is maybe we'll need to talk about making a little clearer, and Mike's covering it. I mean, he's describing the whole technicalities of the system in a short space of time. So if anyone feels overwhelmed, don't worry. So I often do myself. Yeah, but so we're just now giving you a structure. You can go back through these diagrams and ask more questions, but here this covered the idea of the issuing the bank issuing a promissory note to, let's see, the regional bank issuing a promissory note to the commercial bank. So there's all along these chains, the same bill of exchange is backing all of these transactions. So if there wasn't a good deal between this and this, you're not going to have a bill of exchange to offer to the bank, who will then rediscount it here. So if this all sounds very detailed and confusing, it's simpler, you know. We'll keep working on how to simplify this, but it's just so we have a logical structure. Okay, so then the commercial bank is going to take the money that was created by the regional Fed, and it's going to flow it through the account, and the account is going to buy shares from this corporation. So it's buying the shares and it's paying the money. And as we'll see in a second, the corporation, okay, writes out a check. So that's just the formality of how the shares are purchased. Writing a check from the account to the enterprise that is going to issue the shares to the account. It's going to take the money and it's going to use that. All right, as I just said, it uses the cash that it received from the account that was, you know, ultimately generated here. It's going to take its cash and it's going to go out and buy whatever capital assets it needs. Okay. All right. And then as it's acquired all the capital and it uses it, puts it into operation, it's going to, this is the acquisition, it's going to then sell its new goods and services out in the market and generate new profits. Okay. And all those profits, okay, as it generates the profits, this is step 14. The enterprise makes scheduled payments of dividends. So it's, you know, it has a certain amount that it's promising to repay each loan period. So it's paying out full dividends to the account based on the number of shares. And when it does that, the benefit to this corporation in paying out its dividends is it gets to get a tax deduction, okay, which is a very nice thing for the corporation. So the capital ownership account takes the payments from the corporation and it's going to make its installment payments to its lender. Okay, this is on the principal plus whatever portion of the service charge has to be repaid at that. And as I said, once that is paid off, the loan that this bank made to the capital ownership account, everything, the continuing stream of dividends is now income. This will get paid out of the account. Any dividend income will be paid out to the citizens. And then if they earn over a certain amount, they're going to pay personal income taxes. Okay. And step 16. Okay, so what we have here with the repayment of the loan, and the commercial bank has to make sure it pays off its promissory note to the regional Fed. And when that happens, the loan is all repaid and the money, and this is, you know, Mike will explain this, it's really a bookkeeping procedure. That amount of money that was created is now canceled out of the economy. Now, that's not to say that the money that helped create the new capital didn't, it created new production, which the new production is its income. So, but that original loan amount is now taken off the books. Okay, and what that does is it prevents inflation. So in other words, you never have too many units of currency that are not backed by the new goods and services to be produced. So And that way you complete the chain. Okay, so we have about 5 minutes left. Does anyone, okay, John, you have a question?
Yes. So keeping the graphic in front of us.
Okay.
I understand, and it's a very saleable point. I understand how the payoff to the regional, to the Federal Reserve Bank at the end, after step 16, leaves no room for inflation. It doesn't seem.
That's right.
But let me, the person back in the capital ownership account for each citizen, on average, the numbers you're using, is it a 3 or 4 year return of, meaning that these deals can be all different time periods, can't they?
Right,
in
3
other
to
words,
7 years.
I'm 7 years?
Three
Yeah,
to 7, you know,
3 to 7,
usually,
good,
yeah.
all right. So that would mean that the project has met its target of using the money for a certain number of years, that the interest and all of those other expenses have been paid, and that everything's retired at step 16.
Right.
So there are profits payable to the capital ownership account only after that moment, or in other words,
it'll continue.
As soon as the company gets the money and begins using the new capital for new production within a system in which there's income from the consumption side.
Right.
So,
I think
it's a matter of getting a market system working in a balanced way.
yeah, I think that, John, if I understood you, were you asking about once the loan is repaid, does the corporation continue to pay out dividends to the capital ownership account?
Yeah, well, I'm confused with the terminology. So that's where I was, but no, it doesn't, because that deal is done, isn't it?
Well, no, the loan is paid off. That means everything that those shares continue to produce becomes paid out as dividend income. So that's free and clear of the loan.
So out of that portion, so there's bookkeeping attached to each portion of new money going in for investment. So the other side of that is, what if this meritorious plan doesn't work out? What if something comes along, then the insurance takes care of it?
Yes. Yeah. So one clarification is we don't use the word interest, because this is a one-time service charge and not a continuing fee for the money that's, you know, over the term of the loan.
Cost of money, is there?
It in a sense it's cost of money, but this is, as Mike said, this is not borrowing existing savings where you would be paying interest. This is because this is newly created money that came from no one. It was just, you know, came into existence because you had a productive project that was feasible. You don't have that, you know, the paying for the use of someone's money. So it's a one-time, you know, what are the costs? What are the reason, you know, whatever the profits will be for the lender, and what are the service charges of the central bank? You get that one total figure, and that's, you know, that's going to be the discount for the loan.
So you have quality. It's a feasibility done on the basis of minimizing bad loans and maximizing good loans, so that the security is going to be covered by the service cost, you know, 1 or 2%.
Right. And so you're pulling a lot of people's interest, you know, the insurance premiums. And because, as Norm says, the quality of those loans is going to tend to be, you know, much more scrutinized in this system. At every single level, it's being vetted, that loan. So you know, it's going to be less likely to go bad, but if it does, you're going to have that pool of premiums.
Right.
Sid, I see your hand up, so I want to make sure that.
Yeah, no. I just want to say that, could I get the recording of this? Because
Yes.
I was bumped off the internet
Ah,
now, so I missed it all.
oh no. Okay, yeah, definitely. I will send this out to everyone.
Okay,
As I said, it's with all the warts. That means if there's any, stuff when we first come on, a little chit chat, that's going to be on too until we edit it out. But yes, I'll send this out, and I'll send out the PowerPoint because I think that has,
because I think this is perhaps the most important stuff.
in terms of actually, selling the idea and making it
But this
real.
was Kelso.
Huh?
That's what he said.
Yeah,
Yep.
yeah.
So I'm sorry to interrupt everyone, but I have, as I said, I have to run. So let's see, in the agenda that was sent out at the bottom, we always have the reading assignment and study questions for the next session. Okay, so that's going to be for class 6. You'll have some history, dinner at the Madison, which is kind of interesting. It shows all the political stuff that went on in order to get Russell Long to become the champion of the ESOP. And then we have the longer paper, and this is just one section out of it, but I encourage people to read the whole paper. It's called The Just Third Way: How We Can Create Green Growth, Widespread Prosperity, and Global Peace. And all those things I think the world needs very much right now. I am going to get you guys I'm trying to figure out the easiest way for everyone to get on to the Justice University website so they can play around with the quizzes. Okay. And as I said, because we're not able to get as many questions as we'd like for each class, and I'm not, having each of you send written responses to the study questions, which we did in previous sessions. We're using the quizzes as a way for you to see how much you've internalized of what we've been trying to teach. So again, it's set up so you can keep taking that quiz until you get 100%. And then if you still don't understand why it is, you either got something wrong or right, that's a good thing to raise at the class. But we're trying different formats out to see what will work in terms of helping people understand these ideas. And the final class, again, is going to be a 10-minute presentation that each of you will give. And it's to demonstrate, what you've learned you didn't know before that will address a major concern of yours, where you'd like to focus, how the principles you learned would help address the problem. And some of these techniques, for example, could be brought in. We're not expecting you to be experts, but we want to just see how you would use what you learned. So what I will ask you before next class, which is class number 6, if you could send me at least a paragraph of what you intend to present 10 minutes at the class 10. So if you could send those to me, that way we'll stay on track so no one is kind of caught off guard at the last minute. I want to thank
the date. Do you have the date of class 10 now?
Yes, that would be December 16th, because we extended the session, 1 week. So that is Saturday the 16th. So, and also we want to always get your feedback on where we can improve the presentation. I mean, aside from the fact, yes, the presenters can always do it in a more polished way, but just the structure of the course, we do want feedback. And the quizzes, what you're doing is acting as sort of a focus group for how we're doing the self-paced course. Okay, so we'll get a sense of, were these questions well put? Were they challenging enough? So that's your feedback is valuable to us on the quizzes. So I will ask that everyone complete taking the quizzes, and I'm still trying to figure out how to get you onto the site. It's not as easy as it should be, but continue doing the readings, and you all are really doing a great job. I hope we're imparting greater understanding of the just third way. So thank you very much, and we will see you next week.
Good.
Thank you very much.